Most investing influencers only tell you about their successes. Or, worse, don't share their track record at all. But I'd rather help you learn from my mistakes than put myself out there as another fake guru. If you're new here, I'm Ethan, CFA charter holder and investment professional. Today, as part of our series on the psychology of money, we're going to cover conservatism bias, which is what led to the biggest investment mistake of my career. Despite what it sounds like, conservatism bias doesn't actually mean being too conservative with your investments. I definitely don't have that problem. Actually, it's more like your brain is afraid of change. We tend to downplay information that contradicts our initial opinion. But if our initial opinion is wrong, or even if it's right, but then something changes, that's a problem. And it's one of the reasons that people are better at buying low than they are at selling high. This was the reason for the biggest investment mistake I've made in my career. Near the bottom of the pandemic, I loaded up on a 3x small cap ETF, TNA. It was an amazing buy. I was up around 3 to 4x my money at one point in just over a year. My thesis was simple. Small caps were hit really hard by the market downturn, but that was caused by a temporary factor, and they'd have a strong recovery when the economy got back to normal. All of that was right. But I stayed so focused on my initial thesis of the economy getting back to normal that I didn't sufficiently consider the impact that rising inflation and interest rates would have on small caps. The economy still had a lot of recovering to do, and my thesis was playing out nicely. So I became blinded to other factors that could overwhelm my initial thesis. Luckily, my first buy was more shares than all the other ones combined, and I'm still up quite a bit. But if I hadn't succumbed to conservatism bias and had my blinders on, I would have sold at least some of my position at a much, much higher value. TNA also became almost half of my portfolio at its peak, and I basically wrote it all the way down. In order to avoid this, besides just being more conscious of this bias and seeking out ways that whatever my investment thesis is might not actually work, I've implemented two additional things. First, a new sell discipline on leveraged ETFs that's been working pretty well the last 2 years. You can see how it got me to sell pretty much right at the peak twice in 2023. These were just trims, but I've already been able to buy back the shares shortly after at a steep discount once. I've also implemented a max position size of 25% of my portfolio, so nothing can hurt me quite like this did in 2022. For more on my sell discipline, well, let me know in the comments if you're interested, and if people are, I'll make a video about it. Next, in our Psychology of Money series is representativeness bias. Man, that's a mouthful. That causes investment mistakes, but it's also the main reason behind the existence of stereotypes. Thank you for watching. Thank you in advance for sharing. And if you want to continue the investment conversation, click the link in the description and join our free Discord.